90% of silver investors will get destroyed by this shift nobody's talking about, because what's happening right now in silver is not a rally. It's a psychological trap. Prices are rising, headlines are getting louder, and millions of people are rushing in, believing this is their escape, their miracle, their financial reset. But almost nobody is asking the only question that actually matters. Who is this move really designed to reward, and who is it quietly setting up to erase? Because this phase doesn't destroy portfolios first. It destroys thinking. And once thinking breaks, money always follows. And what comes next in silver won't feel like a crash. It will feel like a revelation. The phase most people never see. Coming. The shift in silver did not begin the day it started trending. It did not begin when headlines appeared or when commentators suddenly filled timelines with charts, targets, and bold promises. It began quietly, long before most people were paying attention. Long before silver became exciting. Long before it became emotional. Long before it became dangerous. For years, silver lived in a place no one talked about. It moved slowly. It is often disappointing. It bored people. While stocks were making new highs and digital assets were producing overnight celebrities, silver sat in the background, ignored by the mainstream and mocked by those who only respected what was already rising. During that period, only a small group of disciplined buyers stayed involved. They were not chasing. They were not emotional. They were not trying to be saved by a price chart. They were simply exchanging effort for ounces, quietly, consistently, without applause. That is always how the first phase works. Then something changed. Silver crossed levels that had rejected prices again and again. It moved through the 20s and did not fall back. It approached 30, paused, and then pushed above it. That moment mattered more than most people realized, because above that level, silver stopped behaving like a neglected metal and started behaving like a story. Stories attract attention. Attention attracts emotion, and emotion attracts crowds. Once silver crested the low 30s, the tone around it shifted. The conversation changed. Comment sections filled, videos multiplied, headlines became louder. The metal was no longer framed as a slow, strategic holding. It was framed as an opportunity, then as a movement, then for many as a rescue. And this is where the real phase began. The higher silver climbed, the more people felt they were being left behind. They did not see the years of boredom. They did not see the small, patient buying. They saw only the recent move. They saw only what had already happened. And they felt the pressure of time, the pressure to act, the pressure to not miss what others seem to already be winning. This pressure is not financial. It is psychological. People did not start asking, is silver undervalued? They started asking, is it too late? They did not ask, what role does this play in a plan? They asked, how high can it go? They were no longer studying silver. They were watching other people. That is always the signal. Because markets do not change character when prices move. They change character when behavior moves. In the early phase, people buy because something makes sense. In the late phase, people buy because something feels urgent. As silver pushed higher, new narratives appeared almost overnight. Old ideas were recycled with new excitement. Industrial demand, technology, energy transition, electronics, batteries, solar. All real topics, all discussed for decades. But suddenly, they were spoken as if they had just been discovered, as if nothing mattered before this exact moment. This is another feature of the shift. When a market enters its emotional phase, information does not become more accurate. It becomes more attractive. Charts are shown without context. Targets are given without timelines. Stories are told without risk. Everything sounds certain. Everything sounds powerful. Everything sounds like it is already too big to fail. And when that happens, most people are no longer investing. They are buying relief. Relief from inflation. Relief from debt. Relief from regret. Relief from years of feeling behind. Silver becomes more than metal. It becomes hope. And hope is the most dangerous asset in any market because hope does not calculate. Hope does not hedge. Hope does not protect. Hope only leans forward. This is where the silver lottery phase quietly forms. Not because silver itself becomes fake, but because expectations become fictional. People stop seeing ounces. They start seeing outcomes. They stop seeing volatility. They start seeing freedom. They stop seeing cycles. They start seeing destiny. And once that happens, the shift is no longer about price. It is about identity. They are no longer someone who owns silver. They are someone who is waiting for silver to save them. And that is the exact psychological moment where risk explodes. Because when an asset becomes emotional support, it becomes untouchable. It cannot be questioned. It cannot be trimmed. It cannot be reduced. It cannot be sold. Any suggestion of caution feels like betrayal. Any talk of pulling capital feels like sabotage. Any reminder of cycles feels like negativity. This is when most people unknowingly lock themselves into the most dangerous position of all in, all emotional, all dependent. They start to believe that higher prices are proof. They start to believe that popularity is validation. They start to believe that constant excitement is strength. They do not notice that the strongest markets are quiet. They do not notice that the most profitable phase has already passed. They do not notice that the conversation has completely changed. Because now silver is not being discussed as a tool. It is being discussed as a promise. And promises are what markets use to transfer risk. At this stage, almost no one talks about exits. They talk about ceilings. They do not talk about protection. They talk about projections. They do not talk about wins. They talk about what they will do after they become rich. This is not analysis. This is fantasy finance. And fantasy finance always ends the same way. Well, not with everyone getting rich, but most people discover very late that the shift they were watching on the screen had already happened inside them. Because the real danger is not that silver could fall. The real danger is that people have stopped thinking about what they would do if it rises. And that is where the destruction actually begins. When price stops being information and starts being persuasion. As silver continued to climb, something subtle but powerful began to change. Price was no longer treated as information. It became persuasive. Every green candle felt like proof. Every new high felt like confirmation. And every pullback was quickly reframed as the last chance. The market was no longer something to observe. It was something that seemed to speak. And what it appeared to be saying was simple. Hurry. This is the stage most people never realize they have entered. Earlier, silver had been discussed in terms of value, cycles, and positioning. Now it was discussed in terms of timing, targets, and inevitability. People did not ask whether the move was healthy. They asked how explosive it could become. They did not ask who might be selling into strength. They asked how soon it could change their lives. The language gave it away. Conversations filled with phrases like, before it's too late, this is it, and once in a lifetime. These are not analytical phrases. They are emotional commands. They are not meant to inform. They are meant to move people. And they work. Because when people believe time is running out, they stop measuring risk. They stop planning. They stop comparing. They compress decisions that should take months into moments. They turn complex financial choices into simple emotional reactions. Buy now. Hold forever. Never sell. This is not conviction. This is captivity. At this stage, many new buyers did not even know why they owned silver. They could repeat headlines. They could quote supply shortages. They could mention technology and energy. But they could not explain what would make them reduce their position. They could not explain what would make them take profit. They could not explain how silver fit into anything else in their lives. Silver was not part of a system. Silver was the system. And that is always where danger quietly concentrates. Because when one idea carries all expectations, it also carries all pressure. Every bill, every worry, every future plan, every regret about missing past opportunities. All of it gets stacked onto the same trade. This weight does not make markets stronger. It makes people fragile. The higher silver moved, the more personal it became. People began measuring their days by the chart. Moods rose and fell with price. Small pullbacks caused anger. Big moves caused euphoria. Social media feeds became echo chambers of certainty, where doubt was treated as ignorance and caution was treated as weakness. Anyone who suggested reducing exposure was accused of not believing enough. Anyone who spoke about cycles was accused of being negative. Anyone who mentioned history was told, "This time is different." That sentence appears in every mania, not because it is true, but because it is necessary. Without "this time is different," no one would be able to justify abandoning discipline. Without it, no one could defend ignoring risk. Without it, no one could stay emotionally all in. So new reasons were elevated, old warnings were dismissed, and the story of silver slowly changed from opportunity to destiny. And when a market becomes destiny, it becomes untouchable. At this point, a strange inversion begins. The people who bought early start to feel uncomfortable, not because price is falling, but because behavior is rising. They recognize the tone. They remember previous cycles. They see excitement replacing understanding. They see followers replacing planners. They see spectators replacing participants. They notice that no one is talking about how to secure a win, only about how to never miss a bigger one. Meanwhile, the people who arrived late feel the opposite. They feel confident. Surrounded by agreement, reinforced by headlines, and supported by recent price action, they believe risk has decreased simply because attention has increased. But attention does not remove risk. It concentrates on it. This is when price stops acting like a market signal and starts acting like a marketing campaign. Up days are screenshotted. Down days are ignored. Every article seems to support the same conclusion. Every chart is drawn to point in the same direction. And every voice that questions the move becomes quieter, drowned out by celebration. Not because the questions are wrong, but because they are uncomfortable. And discomfort has no place in a crowd that believes it has found its answer. This is the environment where most people unknowingly build their worst positions. They add strength, they increase size, they move money they cannot replace. They convince themselves that patience means never acting and discipline means never selling. They confuse commitment with rigidity. They confuse belief with strategy. They confuse winning with waiting. But markets do not reward waiting. They reward positioning. And positioning always includes exits. By the time most people begin to ask, should I protect this? They no longer feel able to. The price is too exciting. The community is too loud. The idea is too big. Selling anything feels like stepping away from a movement. So they do nothing. And in markets, doing nothing is also a decision to stay fully exposed, a decision to let emotion manage money, a decision to let a narrative replace a plan. And this is how persuasion quietly replaces preparation. This is how participation quietly becomes dependence. This is how a rising market quietly builds the conditions that will eventually destroy the majority of those inside it. Because the shift almost no one is talking about is not in silver. It is in the people holding it. The moment the win becomes invisible. By the time silver reaches its emotional peak, something tragic happens to most investors. They stop recognizing a win. Early in any cycle, progress is easy to see. A small position grows. A slow gain becomes noticeable. A patient decision begins to feel justified. But as price accelerates and attention explodes, the definition of success quietly changes. Doubling stops feeling impressive. Tripling stops feeling meaningful. Being up stops being enough, because once an asset becomes a story, people no longer measure it by what it has already given them. They measure it by what it still owes them. This is where destruction truly begins, not in the crash, but in the erasure of gratitude. In the early phase, someone who doubled their money would call it a breakthrough. They would feel proud. They would feel capable. They would feel like they had finally done something right. That feeling is powerful. It creates confidence. It teaches discipline. It builds momentum. But in the lottery phase, doubling is reframed as still early. Pulling back initial capital is reframed as weak hands. Securing a win is reframed as not believing enough. The crowd slowly teaches people to disrespect their own success. And when success is disrespected, it is always eventually destroyed. Because wins that are not acknowledged are never protected. At this stage, people do not talk about how silver has changed their position. They talk about how it will change their life. They speak in future terms only. They design lifestyles that depend on prices that do not yet exist. They build emotional budgets around numbers that have not yet appeared. Their present progress disappears behind imagined outcomes. This creates a dangerous blindness. Someone who turned a small amount into something meaningful no longer feels secure. They feel impatient. They feel behind. They feel that what they have is insignificant compared to what they believe is coming. So they hold, not because it fits a plan, but because it no longer feels like theirs to touch. It belongs to the future version of them, the version who is debt-free, the version who is independent, the version who finally feels safe. And they do not want to disappoint that version. This is why people do not secure capital in mania phases. They are no longer protecting money. They are protecting an identity. And identities do not scale down. This is also why many people who are up the most are often the most exposed, because early success convinces them they are right. And being right feels like proof that they should be more involved, not less. So positions grow, risk expands, concentration increases, and diversification quietly disappears. All the while, something else fades. Options. When someone pulls back initial capital, they create space, they create flexibility, they create emotional distance. They give themselves permission to think again, to reassess, to act. But when someone leaves everything inside, they lose all three. They become dependent on one outcome. They become sensitive to every fluctuation. They become psychologically trapped in the position. Every red day feels like theft. Every green day feels like relief. This emotional oscillation is exhausting. It narrows thinking. It shortens time horizons. It makes people reactive. And reactive investors do not make strategic decisions. They make survival decisions. They defend positions. They explain losses. They justify exposure. They wait. And waiting feels safe until it suddenly isn't. Because the market does not ring a bell when the emotional phase ends. It does not warn people when enthusiasm peaks. It simply changes behavior again. Volatility increases. Moves become sharper. Reversals become faster. Headlines become confusing. And confidence becomes fragile. This is when people first feel the weight of their own exposure. This is when the question appears that had been avoided for months. What if this doesn't keep going? But by then, the position is no longer a position. It is a dependency. And dependencies do not unwind calmly. They unwind under pressure. That is why most people do not lose money at the bottom. They lose it in the middle. They lose it while the price is still high, but certainty is gone. They lose it when the chart no longer gives emotional comfort. They lose it when the story no longer feels stable. They lose it when they realize they never decided what winning actually looked like. Because a win that is never defined can never be taken. And a win that is never taken is eventually taken by the market. This is why the real damage of the silver lottery phase will not be financial first. It will be psychological. It will show up as people who were once confident become defensive. People who were once grateful become resentful. People who were once ahead became frozen because they did not lose silver. They lost the ability to see what they had already gained. And once that is gone, the market no longer needs to fall to destroy them. They are already positioned to do it to themselves. Why? Most will lose, even if silver goes higher. The most uncomfortable truth in markets is this. Many people do not lose because price moves against them. They lose because price moves in their favor and exposes what they never built. Discipline, boundaries, a definition of enough. In the silver lottery phase, destruction does not require a crash. It only requires time, because time is what reveals whether someone is managing a position or whether the position is managing them. By this stage, silver no longer feels like an asset to most participants. It feels like a verdict. Every tick seems to confirm or deny who they believe they are. Smart or late, aware or blind, chosen or left behind. And when money becomes identity, rational decisions become almost impossible. This is why so many people will lose even if silver continues to climb. They will lose flexibility. They will lose emotional control. They will lose the chance to convert progress into stability because they never decided what stability meant. They never decided what would make them safer. They only decided what would make them richer. And those are not the same thing. A person who doubles an investment and removes their initial capital does not just secure money. They secure their nervous system. They create breathing room. They remove urgency. They turn a trade back into a tool instead of a lifeline. From that position, every future decision improves. They can hold without fear. They can add without desperation. They can wait without anxiety. They can exit without panic. They are no longer negotiating with hope. They are operating from strength. But the silver lottery phase teaches the opposite behavior. It teaches people to leave everything exposed. It teaches them that real believers never take money off the table. It teaches them that protection is weakness and caution is betrayal. So most people never harvest the one thing markets are actually designed to provide, a realized win. Instead, they chase an unrealized future. And unrealized futures are fragile things. They disappear quietly, not always with headlines, often with boredom, with chop, with reversals that go nowhere, with months of movement that drain energy without delivering clarity. This is how most people are destroyed, not by one violent drop, but by a long erosion of confidence. They begin to question silver, then themselves, then the entire process. They feel fooled, they feel angry, they feel embarrassed. They stop engaging, they stop learning, they stop participating. They do not just lose money, they lose momentum. And momentum is far more valuable than any single trade, because momentum compounds. Once a person learns how to secure wins, their entire financial behavior changes. They think in stages. They manage exposure. They recycle capital. They stop looking for miracles and start building systems. They stop needing one asset to save them. They start using assets to strengthen them. But when someone rides an emotional market all the way up and all the way down without ever acting, they learn the opposite lesson. They learn that effort does not pay. They learn that patience means pain. They learn that every opportunity ends in disappointment. And once someone learns that, they rarely try again. This is why the coming shift in silver will not be remembered for how high it went. It will be remembered for how many people believed it would finally change everything, and how many of them walked away convinced that nothing ever does. The quiet winners of this cycle will not be the loudest voices. They will not be the ones with the highest targets. They will be the ones who took their wins when they still felt small. The ones who protected progress when it was still uncelebrated. The ones who used silver not as a fantasy, but as a training ground. A place to practice discipline. A place to practice exits, a place to practice becoming someone who finishes profitable decisions instead of someone who only starts them. Because the shift nobody is talking about is not in the metal. It is in the mindset required to survive it. And in every major silver move in history, only a minority ever made it through that shift. Not because they predicted price, but because they defined victory and acted on it.